Good afternoon, Simple Plan community. It's great to be with you again this week. Looking forward to checking out some pretty pertinent and interesting topics that I think you're going to find very valuable for what we've all been through over the last almost year and a half now. Times have been kind of crazy. It's time to take stock. I'm Brad Macbeth. I'm a licensed advisor across Canada. And you can find us on Facebook at Macbeth Group. You can also find us on Twitter and on Instagram, Cash Coach Canada on Twitter and Macbeth Group on Instagram. Our special offer for today is, our sponsor actually is the Simple Plan community. You can join the Simple Plan community at facebook.com/groups/Simple Plan community and travel with a group of like-minded families and individuals who are looking to make the most of their finances and take care of business in their own lives. As always, we have a helpful tool for you. It's our free cash flow tutorial, which is especially going to apply to what we're looking at today. You can find that at bit.ly/worksheet tutorial. That's https://bit.ly/worksheet tutorial. So thanks again for being with us. I've been reflecting, we're hoping that the global pandemic that we've all been dealing with since March and some longer, but here in North America, really, since March 2020, so that's 16 months. It's time to really take a look at what we've learned, especially in the realm of our finances. It's been a very difficult time. I certainly can't say that, yes, this is all in the rearview mirror. I don't make that assumption. I just think we're in the latter phase, we hope, of this. Things are returning to normal-ish, and in some ways new normal. And hopefully that trend continues. So of course things may fall back for a time. We don't know what's going to happen. But with many people returning to work, with many businesses reopening, and with government subsidies starting to subside, we're all going to return to some form of normal for our finances. And now we can take a look at what that's going to mean for us in the future. How can we be better prepared for future financial upheavals? And so I want to offer you 3 tips today that are essential and maybe share with you my own story. So I'm going to start with the tips. Just for those of you who are short of time, let's just get right to the meat and potatoes of what we're going to look at today. And so we've got three things that can help you be completely prepared for the next global or national or local emergency. We have no way of predicting what's going to happen. We don't know what's going to go on. Certainly in 2019, none of us were expecting 2020 to turn out the way it did. And so just because we don't know what's going to happen, we can be as prepared as possible for what might happen. So one of those things, the first essential tip, is to manage your money. And that really has 3 components to it. One is to know your expenses, another is to know your income, and the third is to manage your cash flow. Now we, a couple of weeks ago, really delved into cash flow for a couple of weeks. And so I really encourage you to either go back and rewatch those or just go to our cash flow tutorial that I gave you the address for already, and I'll give it to you again later, to see what it really entails to manage your cash flow well. So by knowing your expenses, that means that we know really exactly what we're spending in any given month. And that really has 2 types of expenses. They're the ones that are somewhat fixed. So they recur regularly and they're generally the same. So that would be things like your cell phone bill, could be your mortgage payment, and all sorts of other types of basics of life kind of things. Could also be debt payments, things like car loans, and heaven forbid, credit card payments. But there are also a range of expenses that have some discretionary aspect to them, but are still essential. Those would be, one of the best examples of that would be food. We have to buy food, but we don't necessarily have to spend as much as we do on food. Or perhaps you do if you're really living close to the bone with your groceries. And there are other things, clothing. Well, we need to have some clothing, but maybe we don't have to spend much on it at times. And then there are other things that are fully discretionary, like we don't have to go on vacation, for example. Though I know some of you are probably crying out now saying, oh my gosh, that's all that keeps me going. That's the most essential expense. So you need to know your expenses. You also need to know your income. And in this job market, in the way that people are making money in these times, that can be particularly interesting. Of course, if you have a regular full-time job, then you know your income pretty well. But many people have multiple jobs. They have part-time jobs. They have side gigs. Some even have jobs that are in that new part of the economy that's fueled by apps, things like Skip the Dishes or Instacart, or I suppose even some of the accommodation-based apps where you're renting out space in your home, that kind of thing. Airbnb, VRBO. So your income may fluctuate, but you can get a handle on what the core income is that you can expect. And then finally, you have to have a way to manage your cash flow. And by that, what that means is you have to know when money has to go out and when money is coming in. Because knowing your expenses and your income can help you determine if you're making enough money to live. But what they can't tell you is, am I going to have enough cash on any given day to do what I need to do? Now, of course, you can have cash reserves and help to smooth all that over. But having a cash flow system, and again, we talked about that in our cash flow tutorial, is essential to managing your money on a regular basis. So managing your money is the first essential tip for being prepared for emergencies that come around. Now, the second thing that you can do to be best prepared for emergencies and for everything financial in life is to get rid of debt completely. And so what I mean by that is eliminate credit card debt. It's really a toxic thing in your life to have debt hanging over you that you have to make payments on every month. Now, I'm not suggesting that if you're using a credit card and you are comfortable using it responsibly, paying off your credit card balance every month, I'm not suggesting you can't do that. What I am saying is that, listen, if you've got credit card debt that's not getting paid off every single month, then you are digging a hole. And generally speaking, what we see with people is that that hole just tends to get deeper and deeper over time. That includes not having car loans. Car loans are the number one non-mortgage debt that are burdening Canadians. And the average car loan is in the $500 to $600 a month payment range. That is a lot of money. You have to earn even more money than that on a monthly basis because you're going to have to pay tax, EI, CPP on that. So it's very painful. And don't be fooled by either credit card debts or car loans that say, oh, it's 0% financing or anything like that. Listen, none of that is ever true. It's not 0% financing. They're just restating the way in which they make that happen so that you think you're getting some kind of a benefit. But the truth is you're not. And how can I prove that? Well, how do you think the car finance companies float their boats? It's not by not charging any interest. And how do credit card companies survive? They survive very well, thank you, and they survive by extracting money in all sorts of ways through the transactions that take place. So there is no zero cost credit card debt, or car loan debt. There are no free debts. Now, if you need to, and of course, in the housing market the way it is, you may well need to have a home mortgage. And so that's fine. But I'm just going to say that you should be paying that down as responsibly and reasonably aggressively as possible. Now, by that, I mean, and we'll talk about this on another show another time, but by that, I mean, be sure that you're paying it down. Because there are some people that have home equity lines of credit where they're making interest-only payments. Those are a terrible idea for that purpose. But if you can, you should set up your mortgage, your home mortgage, so that you can pay it down fairly aggressively. Now, you don't want to forsake having a life, and you don't want to forsake having other forms of savings that are essential, like you need to be saving for retirement, maybe you're saving for your children's education. Don't just pay your house down and forsake those other things. They're important as well. But eliminating debt will go a long ways to helping you cope through any emergency that comes, whether it's personal or whether it's global. And then finally, you need to have an emergency fund. And so we define an emergency fund as 3 to 6 months of expense money. Now, what does that mean? Well, it means a couple of things. First off, expenses are those things that you have to spend in any given month. By definition, if we have an emergency, it's going to go on for a limited period of time. Now, the pandemic we've been living through has gone on for a very long period of time, relatively speaking. But the expense money in that kind of a time frame is what do you have to spend on? So, for example, well, you probably have to make your mortgage payment or pay your rent. You probably have to pay your light bill and that kind of thing. Those are just obvious. You do have to eat. But as I mentioned before, maybe I don't have to eat as well as I have been in better times. So if times are difficult, maybe I say, well, listen, I'm going to, if I've been enjoying, fancier groceries or whatever, maybe I say, listen, I just need to cut back. What is the minimum amount I need to spend to eat reasonably? And so that would be part of your emergency expenses. For a limited period of time, I can certainly go without buying new clothing. I can forsake vacations. I can, there's lots of discretionary things I don't have to spend money on in an emergency period. So you want to kind of have a handle on what your essential expenses are during an emergency. And you need to be realistic about that because, yes, there are things you have to pay and you don't want to be going into debt and you don't want to be falling behind on paying your bills. Now, another rule for the emergency fund is the money needs to be readily accessible. So 3 to 6 months of expenses, that can amount to a fair chunk of change. You could be maybe you're only in the $5,000 range, but it could be $10 or $20 or $30,000 or more. And then people start to feel like, well, I don't want to just have it in a savings account where I'm not earning any return. I'm going to invest it. That is a bad idea for a couple of reasons. Number one is whenever we invest money expecting a better rate of return than a guaranteed rate of return, because guaranteed rates of return right now are somewhere in the 0.05% to maybe 2%, 2.5% range. But if we're expecting or seeking a better return than that, we're going to be taking risk with our money by investing it in things like mutual funds that have equities in them or that kind of thing. No guaranteed rate of return and with a potential for some losses. We don't want to be in a position where when we go to get our emergency fund, the money is not all going to be there because that's in a particular period where the market's gone down. So by readily accessible and not at risk, we mean that it's in an account where we can get it today or within the next couple of days, and that we are not putting that money at risk so that it might be a lesser amount than we had anticipated. So that's strictly for your emergency fund, but it's really important to do that. The 3 to 6 months factor in your expenses, how do you determine if it's 3, 4, 5, or 6 months? Well, here's how I look at it when I work with clients. If you have a highly stable job that is unlikely to end or for you to be laid off or cut out of it, then you can probably get by fine with just the 3 months. So, for example, people in really essential industries like many government jobs or government-related jobs, so teaching, healthcare, police, firefighters, that kind of thing, and there are others in the private sector as well. So that would be the folks that could be confident about the 3 months. For those at the other end of the spectrum, we have people who do not have a reliable or necessarily regular income. And I'll give you 2 examples of that. One would be if you're self-employed. So if you're self-employed, let's look at the pandemic and we've gone through it. In some jurisdictions, now we're in British Columbia, so we've been fairly open most of the pandemic, at least in a limited way. But in some jurisdictions, a lot of things have been closed. So let's say, for example, you were a hairdresser or a fitness trainer in a jurisdiction where those things were really shut down for many, many months. Then you're self-employed. So you probably want to have 6 months of expense money set aside for that emergency period. And so you can determine the stability of your position, the reliability of your paycheck, and your comfort level for how much expense money you should have set aside. Is it 3 months, 4 months, 5 months, or 6 months? So just to review those rules, we want to manage our cash flow. We want to eliminate all debt. And we want to have an emergency fund. Now, I just want to share with you personally my perspective from our experience on this. And I'm going to compare and contrast 2, I'll call them global emergencies. In 2007 to 2009, there was a global economic meltdown that took place in that period. And it was deeply alarming. It was unprecedented in my lifetime, though not unprecedented entirely. And it was very concerning, and things were extremely uncertain. We hit the bottom of that in early March 2009. But I can tell you on that day, in March 2009, we did not celebrate saying, hey, we've hit the bottom, it's going to start going up now. Because, of course, we had no idea. For all we knew, it was going to keep going down. And, let's say that investments at that point were down, call it approximately 40% across the board. Of course, there was variation there. That was a very worrying time, and it implemented some fairly recessionary times for a period. And it was just very alarming. Now, at that time, if I were to look at our 3 tips to be ready, managing your cash flow, we weren't doing that in my house. Not well, not clearly. We were getting our bills paid, but really not managing that well. And that's really the state that most Canadians are in right now, is they don't have a system. They just have money coming in and money going out. And as long as the money keeps coming in, it'll keep going out, and everything will kind of move along in a shaky way. We did not have only mortgage debt. We had a bunch of other debt. We had recently finished building our dream house, and we had a lot of debt accumulated from that. And then finally, we had no emergency fund. So even though through that period, our incomes, from the financial services point of view, things got a little tighter, which was the business I'm in. But my wife's income didn't really dip. We were fortunate. But even still, um, a lot, a lot of that financing we had was affected because banks and credit companies began to tighten up. And so they stopped granting credit. They started pulling in, expecting lines of credit to be paid. They capped flexible lines of credit and that kind of thing. And it froze our ability to manage our money or to cope. It wasn't because we weren't managing it. It froze our ability to cope with it. And it just made things very difficult. And from that, we went through a long period of where things were pretty miserable financially. We still had money coming in, but it was getting harder and harder to pay bills. Things were falling behind. And eventually, we decided that we had to sell our house in order to kind of reset and clear the decks. And we embraced the principles that I now work with clients all over Canada on, that have those simple rules in the simple plan to plan, protect, and progress, including the three recommendations that I made today, the 3 tips for being prepared for financial emergencies. And it took us a number of years to turn that all around. And it was disappointing. It was very disappointing to sell off the dream home that we'd built and to move from there. And there were other hardships that came with it. However, after a year or two, things really began to turn around. And fast forward to 12 years later, and the next global emergency, the coronavirus pandemic. Now, this time, we have no debt. This time, we have a system that we have used for years now to manage our cash flow, which is exactly that cash flow tutorial. Describes exactly how to do that. That's available to you free. And we have an emergency fund saved up. In fact, we have more than that saved up. So we've never really been at all concerned financially through the pandemic. Now, I'm not trying to suggest that everybody can be in that position. And I think it's awful, some of the economic hardships that people have been going through the pandemic. And we certainly have family members whose industries have been completely shut down for long periods, that have been, kind of struggling to cope. And it's been hard. It's been hard on them. However, if they had those emergency funds in place and a method to manage their cash flow, they would be, and they didn't have debt, they would be in a much stronger position. So even though they would have financial difficulties and burden, they would have been able to much better manage these things, or at least have much less anxiety about it. And I'm very sympathetic to the anxiety that people have had, the hardship that people have had. I feel very badly for the many businesses, small businesses across the country that have been suffering or that have closed. And even if the pandemic is largely behind us, the economic fallout is going to carry on for quite some time yet. It's been very painful. But we can be better prepared for these things. And unfortunately, most Canadians weren't, and many have suffered. And while things would have gotten difficult for them, they wouldn't have suffered nearly as much if they were better prepared to manage these things. Now, the government has stepped in to help shore things up, but the government has really reached, and I would argue gone far beyond its ability to do that. And we're going to reap the whirlwind of that, both with inflation, and we've downloaded a massive amount of debt onto our children and grandchildren and decades beyond that, with the hundreds of billions of dollars of extra spending that the government has done over the last 18 months. The unfortunate news for everybody is that the government, and we saw this very quickly, the government can't really float the economy. If the economy struggles. It's people who have to step up to it. And, and the best, easiest way to step up to it is to be prepared to deal with it if there are emergencies. Now, again, I'm not saying the government shouldn't have done anything. I'm not saying that at all. And I again know many people who've benefited and been able to keep their economic life going because of the government benefits they've been receiving. But it's not a very good answer, and it's one that where we've just really shifted the cost into the future, and we're going to be paying for that for a long time. So I would argue that it's much better for us individually to be prepared so that the need is much lower than what it was this time around. Anyway, the best thing out of all of that is the peace of mind. Believe me, when you have an emergency fund behind you and you have a complete handle on your expenses, you know what you could cut out or eliminate on a moment's notice without any difficulty, then you are in a much stronger position. And if you have no debt that's demanding a payment every single month, then you're in a much stronger position when emergencies come our way. Emergencies are always going to come our way, and we are not going to know where they're going to come from. Right now, as I'm broadcasting this, there are devastating floods happening in Europe and in China, and there are fires happening in my part of the world, including a fire that wiped out an entire village. Not the people. There tragically was a death there, but most of the people, almost all the people, got out safe. However, the entire town was destroyed, and that is going to be a major economic fallout. But if you have that kind of emergency in your life, and you have things like an emergency fund and no debt and a handle on your finances, it doesn't eliminate the tragedy of that, but it gives you a much stronger position from which to deal with it and to work through it in your own life. So I hope that's been helpful for you. Once again, I encourage you to join the Simple Plan community. You can do that at facebook.com/groups/Simple Plan community, where many like-minded people gather to look at how to operate their day-to-day finances on a continuing basis based on these types of thoughts and principles. And if you're wanting to get that handle on your cash flow in your life, try our free cash flow tutorial. It gives you all the instruction and all the tools you need to do that. You can get that at bit.ly, that's bit.ly/worksheet tutorial. That's bit.ly/worksheet tutorial. Thanks very much for being with us today. We are live every week. We'll be live again next week. You can find us on Facebook at Macbeth Group. You can also follow us on Twitter at Cash Coach Canada or on Instagram at Macbeth Group. I hope you have a great day, and I wish you financial peace. We'll see you next time.